What is up, everybody? Welcome back to Bitcoin and Markets. Hope you guys are doing well on this Wednesday. There was some action in the Bitcoin space with Gary Gensler testifying in front of Congress. We're not going to go over that. There wasn't really much that he said. He did say that, once again, Bitcoin is not a security, according to Howie, and that is the only digital money that is that way. He won't say that about Ethereum. He won't say that about anything else. So that's pretty much the only thing that came out of that meeting. Also, before the meeting, they did send a letter. The entire committee, I guess, sent a signed letter to Gary Gensler saying that, or to the SEC before this testimony today, demanding that they approve the Bitcoin spot ETF. So things are really heating up, and I will, of course, keep you guys as updated as I can. But the main place I hang out is on Telegram, t.me/Bitcoin and Markets. So you can check that out. Also on Twitter, @Ansel Linder. I'm live streaming there on Twitter, Rumble, and YouTube. If you guys are watching there, please like and subscribe. Comment down below. I will get to all the comments later after the live stream because I'm not quite capable enough yet of answering them live, but we will grow and learn. Okay, let's share the screen. BitcoinandMarkets.com. This is where you can find all my content. Oh, also this morning, the latest Bitcoin Magazine Pro post went out. And so check out bmpro.substack.com. Also, just reading the article, going and clicking on it, giving it a like, shows Bitcoin Magazine that people appreciate the content there. But anyway, this is BitcoinandMarkets.com, where my podcast stuff, my newsletters come out, my personal newsletters. So check that out. You can subscribe to free tier there as well. Okay, so let's get into some of these charts. Bitcoin price. Another day has gone by that we're at 26,200. Pretty soon that will be in the rearview mirror. Okay, all the talk out there that I've seen, a lot of talk out there about this dollar wrecking ball. And it has just gone parabolic at this point. I think it's like 11 weeks in a row that it is green. I wanted to put a fib on here, and we're getting close to a 50% retracement. I thought we would pause around the 38.2, but we did not. I'm going to copy that image, send that over to Telegram. Let's make sure all of my levels are correct where I'm streaming. All right. So yeah, this could have a correction around the 50% fib. That would be my next expectation for the dollar wrecking ball. I don't think it's going to go extremely high because there is a lot of stress in the system right now. I think there's something happening in the background, whether that is in Japan or Europe or in China. I don't think it's not centered on the US right now because we see this really strong dollar move, which is typically pushed by foreign developments. We can take a look at the broad dollar index, and it has not followed all the way, but let's strap a fib on here as well. Of course, this is going to be closes and not wicks or anything, not any intraday moves, but it is also getting close to 50%, but it was higher back at the beginning of September. So that's the difference we are seeing here with the DXY and the broader dollar. But if we go over to the euro, my God, it is just collapsing here down to 104, and it's headed back to parity. Remember this back here, September of last year? That was a really bad month as well last September for the euro. So perhaps there's some seasonality here to this. It did bottom at the last week of September and finished at a green candle last year. So we will see how that works out this time. Okay, another talking point has been the 10-year. This is also going parabolic. And it's interesting to think about, okay, the dollar is screaming higher, but so is the 10-year. So that's extremely bearish for foreign debt out there, dollar-denominated debt. Extremely bearish for them because if they're rolling over debt right now, they're rolling it over from, say, last year or whatever at much higher yields. Maybe they can't even do it. Maybe there's going to be contagion spreading and the counterparties don't want to do it. So this is a very critical time right now in, I would say, offshore markets. because of the 10-year and the dollar. But also look at this. So it topped last year at the beginning of November, beginning of October, mid-October. So September and October was also this period last year that went from down here at 3.3% all the way up to 4.3%. So a full percentage point move last September and half of October in the 10-year. And that's what we're seeing here as well, a blow off top. But the theme of this video and this podcast, whatever, is that we should expect rates to peak here soon and roll back over. And not very many people are buying this at all out there, but I am going to go through why I think that is. Okay, let me go to this tweet. This is a tweet that I made, a couple days ago. And this James Lavish that I follow, he has a bunch of macro stuff. If you still believe that we are going to escape unscathed from the sins of the Treasury and the Fed, you have not been paying attention. I mean, there's so much misunderstanding in that tweet, but he's showing the 10-year screaming north, and I respond with this. Most people see this as just the beginning of the bear market in bonds. So the yields are going to continue going higher and higher and higher. But it's close to the end, in my opinion. You won't recognize it has peaked until months after the fact. Lots of people will be caught off sides. And Checkmatey responded to me. He said, would you mind expanding on this? I can see the case for higher yields for sure, more issuance, quantitative tightening, foreigners shoring up balance sheet, etc. So let me explain that. So he sees a case for higher yields. So more issuance is supposed to drive yields up. I don't believe that is the case, and we'll get into why that is wrong, in my opinion. Quantitative tightening is a drop in the bucket. It doesn't really matter all that much. They're not even selling treasuries. They're just letting things roll off their balance sheet. And if more than the amount rolls off their balance sheet that it's supposed to, they rebuy. So there is some kind of stealth QE even happening in the treasury market. And foreigners shoring up balance sheet, we'll get into that here in a little bit. For rates to decline, I sense it would need QE or yield curve control. I have nothing against Checkmatey, whatever. I think he's a Glassnode guy, super competent out there in the space. But look, he's thinking everything revolves around the Fed. Everything revolves around the omnipotent Fed that can just turn their dials and move things the way they want. That QE is going to cause rates to fall when we know for a fact that rates fall prior to QE. Rates fall not because of the Fed, but because of the market. The market is in control. The Fed is not the tail wagging the dog here. The market is moving and the Fed follows. This is obviously possible, but feels like it's some way off. Okay, so then I didn't see his initial response, so then it took me a day and a half to respond, but here we go. This is what I said. I said, I'm trying to give a thorough answer. A vast majority of UST supply is rehypothication in repo. And we're going to go over exactly what that means here in a second. In good times, it is effectively perfectly elastic or infinite. And this is the supply. Now, remember, I've been talking a lot about elasticity of supply recently and inelastic supply. Well, in good times, the supply curve for US Treasuries is flat. Why is that? It's not because the government is issuing a bunch of new treasuries. It's because they can go out in the repo market and get rehypothecated treasuries whenever they need it. There's no limit. They can be created at will by a loan. I mean, not more treasuries aren't created, but people can put the same treasury on their balance sheet. So you have a long list of people that are claiming ownership of the same treasury. And in good times, that's fine. People willingly do that, and they expand the amount of collateral in the system through rehypothecation and collateral chains. Demand is the only important variable in that case. As the market senses crisis or tighter times ahead, supply starts becoming increasingly inelastic. So this rehypothecation, infinite rehypothecation possibility in good times starts getting curtailed when the banks start sniffing crises ahead. It becomes less than perfectly elastic. And that's not good because collateral chains, they start to shorten and contagion spreads slowly at first, but then rapidly. It's counterintuitive because rising rates means supply is rising relative to demand. So this is just the common supply and demand. If demand is rising relative to supply, price goes down. And price in the bond market is rates going up. So rates will go up as supply goes up relative to demand. That is the intuitive, kind of commonsensical Econ 101 of what's going on here. But that is only the first phase. Supply is dynamic, but takes time to be affected through standard length contracts. Okay, so supply is dynamic. That means as this supply curve starts becoming inelastic, as the banks are sniffing trouble, collateral chains are going to shorten. And that takes time to work its way out because, some transactions will be locked in for 3 months, maybe 6 months. One of the reasons why a lot of stuff happens around the end of Q3 seasonally is because banks have certain reporting requirements that they do at the end of the government fiscal year or, at the end of Q3. And so these banks are starting to air their dirty laundry around this time. That's why the crises happen around the end of Q3. But anyway, it takes time for these contracts to get exchanged for new contracts that are more defensive. So that's what I say here. For example, existing transactions and contracts need to be slowly replaced by more defensive ones. That's why it doesn't happen all at once. There's a tipping point, but then the yields start going down because supply is getting restricted due to more inelastic issuance in the rehypothecation market, and collateral chains are shortening. Okay, in that period, a dollar shortage, or that's what we're seeing right now, China selling treasuries for dollars, can move yields higher, but not for long. Phase one ends when the tipping point has been reached, where declining elasticity via collateral reuse becomes dominant, and that is phase two. The collateral multiplier has been estimated to be about 7 as of 2019. And I linked to this. Let's pull this tab up. And guys over on Telegram, I did put this in Telegram in that whole discussion thread that I had this morning. But anyway, the title of this paper is Understanding Collateral Reuse in the U.S. Financial System. It's by Sebastian Infante, Charles Press, and Zach Sarave. I believe it was written in 2020, and the numbers they're using, I think the latest are 2019, but they're looking at this collateral reuse. So let me just read some of this. Financial market intermediaries, such as broker-dealers, circulate financial securities as collateral through various contracts. The use of securities as collateral allows dealers to perform certain functions that improve market efficiency. For example, dealers use collateral to raise funds through secured financing transactions, or SFTs, or to satisfy margin requirements for derivatives positions. So there's a lot of reasons why they're moving this collateral around. They're rehypothecating it. They're using repo. They're doing all of this stuff. That's the plumbing, the lubricant of the plumbing of the system. Okay, and there's lots of reasons why they need to do this to meet short-term funding obligations. Most contracts allow dealers to reuse collateral, to use collateral that is sourced from another counterparty to be returned at a later date. For example, dealers reuse collateral to finance their secured lending or to source and deliver securities that may be in high demand. Reuse enhances the benefits of collateral use, increasing the collateral's underlying market liquidity and allowing dealers to more efficiently distribute securities, resulting in lower issuance costs. So this is what I'm talking about. Reuse of this collateral or treasuries, when it's functioning great and fine, there is no limit to how much they can reuse. The elasticity of supply is perfectly elastic. Only demand matters. But in bad times, reuse starts to slide and not work as well. And so that constrains the supply way more than any difference in issuance from the government or from the Fed doing QE or QT. That has very little to do with the long-term path of rates here. But let's continue. However, collateral circulation is not costless. The use and reuse of collateral can create collateral chains, where one security is used in multiple transactions. These chains lead to greater interconnectedness and increased uncertainty as to who holds the collateral, potentially amplifying fragility in times of market stress. So see, market stress. In times of market stress, or what I said, sniffing out some sort of crisis coming, then that is where it amplifies the fragility of the market. And we see times like in the Great Financial Crisis or in September of 2019, even in the COVID crash, markets completely freeze because they're amplifying security by reuse of collateral. The trade-offs associated with collateral reuse have garnered increased attention from regulators. Despite its importance, there are relatively few measures of collateral reuse for the U.S. financial system. And this is something that Jeff Schneider says all the time. People have stopped studying money. The Fed doesn't know what money is. They don't know how to count money. They don't know how to count this collateral. It says there are relatively few measures of collateral reuse for the U.S. financial system. Why in God's earth would that be the case? It's 2023 and there's relatively few measures of this. That's criminal. Using confidential supervisory data, CSI, we measured the amount of collateral reuse in the U.S. at the individual dealer level with a particular focus on the U.S. So they're going to give us some numbers here. The data shows that most collateral received is eventually reused, indicating a high degree of collateral circulation. Focusing on US Treasuries, we plot the total amount of incoming and outgoing collateral, specify the contracts through which financial institutions conduct such activity, and construct an index to measure the degree of collateral reuse. In this paper, we put forth three possible drivers for dealers' high level of U.S. Treasury reuse. Number one, intermediation of cash through the special financing transactions. And two, intermediation of specific Treasury securities that may be in high demand. And finally, number three, stripping and distribution of the safe asset benefits of U.S. Treasuries in good times. Importantly, this last driver highlights that U.S. Treasury reuse does not create new safe assets, but rather allocates safety efficiently throughout the financial system in good times. Using regulatory data to measure reuse. Quantifying collateral reuse has traditionally been a challenging endeavor that relied upon important assumptions due to limited data. Issuing novel regulatory data collected by the Federal Reserve, we measure the level of reuse of individual institutions, specifically large dealers associated with bank and intermediate holding companies. The data, described by Infante Press and Strauss in 2008, allows us to identify SFTs where collateral is received or delivered, the type of contract employed, the type of securities exchanged, and whether incoming collateral is encumbered or outgoing collateral is rehypothecated. Our sample consists of a subset of primary dealers, which are at the core of many financial markets and are therefore representative of the financial system. They are especially representative of the U.S. Treasury security flows because primary dealers are trading counterparties of the Federal Reserve Bank of New York, which requires them to participate in Treasury auctions. Because the majority of banks' securities activity is conducted by their dealer subsidiaries, the analysis at the bank holding company gives similar results. For these reasons, we believe dealer-level measures of collateral reuse are the most relevant. So they're just going through some background of what they're doing here. Maybe I can skip this section. Quantifying collateral reuse. To further understand the level of and dynamics of collateral circulation, we develop a measure to quantify the degree of collateral reuse. Our measure, called the collateral multiplier, is calculated at the firm level and averaged across the firms in our sample. Since primary dealers lie at the core of collateral circulation, averages of our firm level measures are valid proxies for estimating reuse at the system-wide level. The collateral multiplier is the ratio of the amount of outgoing collateral to the amount of collateral that is outright owned but financed through SFTs. The collateral multiplier, money multiplier, measures SFTs as a multiple of the total amount of collateral owned. All right. Let me go down here. So when they're talking about the collateral multiplier, that people will understand fractional reserve banking. Fractional reserve banking is when like your deposits only have to cover, say, 10% of your loans. You know, you only have to keep 10% reserves to cover all of the loans that you have. And it makes, there's this multiplier effect. So if it's 10% of reserves, then there's a 10x multiplier from reserves to loans that you can make. Well, there's also a multiplier here that they're calling a collateral multiplier. That is how many times on average is the same treasury relent, rehypothecated. The total amount of treasuries, what, 33 trillion? So what's the multiplier? What's the real circulation out there of treasuries? And does 20 billion a month in QT or whatever they're doing, does that even matter? Does new issuance of 600 billion even matter? Or is it a drop in the bucket? Well, let's read some more here. Figure 3 plots the collateral multiplier for the US Treasuries. Okay. This multiplier is significantly higher for treasuries than for all other collateral classes. The collateral multiplier can be interpreted as a proxy for the length of the collateral chain, where one specific security is used for multiple transactions. Under this interpretation, the data suggests that dealers use one treasury security between 6 to 7 times. And this level of circulation is significantly higher than for all other collateral classes. So 6 to 7 times. So let's just go with 7. That means 200, roughly 200 and about $20 trillion worth of treasuries are floating around out there. Rehypothecated treasuries. 220 trillion. Do you think 80 billion a month matters? No. Do you think the recent awe-inspiring issuance that Yellen did after the last debt ceiling debate shut down, then they issued like 600 billion in a month or two? Does that matter? No, not really. Not when we're talking about 220 trillion. Does the Fed's balance sheet of 8 trillion, does that matter? No. There's $220 trillion worth of rehypothecated treasuries out there. None of this matters. It's all a drop in the bucket. The Fed's policy is about signaling to keep this market stable. All right, so that is what I wanted to say from that. Let me go back to my tweet here, reply to Checkmatey. And so I said that there is a tipping point. Where did I say that? Oh yeah, phase 1 ends when the tipping point has been reached, where declining elasticity via collateral reuse becomes dominant. See phase 2. So this tipping point is where collateral reuse declines enough to pull real supply under depressed primary demand. So yes, right now in this $220 trillion market of rehypothecated treasuries, that is still going on as normal. It's slowly changing as they replace old contracts or transactions with new ones. But think about a collateral chain. That collateral chain is going to be replaced by a new collateral chain, but it might take a long time, like months, maybe even years, for some of these things to get reworked. But in the meantime, in the short phase 1 of this, we can see the initial response of like selling treasuries to get dollars in China to pay their debt because there's a dollar shortage, and the dollar screams higher, yields scream higher. But then there's a tipping point when the collateral chains start breaking down. Shrinking reuse also adds to demand. because these players need those treasuries for proper functioning and balance sheets. Like I said, there's a reason why they do this repo transactions and they need all this collateral, because of the functioning of the bank and the functioning of the system. So if reuse is making the supply more inelastic and there's less issuance of rehypothecated treasuries, they have to go out and buy those. So if they can't get a rehypothecated version, they need to go out and buy it directly. Imagine the multiplier falling by just 1. So if the multiplier was 7 and it falls down to 6 or even 5, it's not like all of that demand that needs those treasuries for the functioning of the system goes away. No, they rush out into the direct market and they start buying it. And that's why you see yields dropping. So yields going up is followed by yields going down. And then that's followed by recession. And I'll show you that chart here in a second. So all this has almost nothing to do with QE or issuance. Like I said, it's a drop in the bucket. This is a $220 trillion shadow banking system. The $9 trillion on the Fed's balance sheet doesn't matter. M2 doesn't matter. Government debt really doesn't matter. Think about 30 trillion compared to 220 trillion. I mean, why would they have to rehypothecate all this stuff and add the supply or artificially create supply up to 220 trillion if 30 trillion was too high? I mean, if it was less government debt, there would be less. Well, hold on. How do I say that? If there's more government debt, then these collateral chains can shrink and still be able to fulfill their functions. So there is no cap to the demand for US Treasuries. They can issue another 100 trillion. That doesn't mean you're going to get productivity out of it. It's just going to grind us lower on the road to a deflationary end to the system. But there is no height there. Like, it's so far in the future to get to 200 trillion from 30 trillion. I mean, maybe it'll take us another couple decades or something. But anyway, that's where I wanted to leave that. And let me just show this other chart here. Okay, so this chart is the one I wanted to show. And guys, on Telegram, I did put this up there. This is responding to, who is it responding to? Bob Elliott. He was on Blockworks podcast, but he was saying that the credit event comes before falling rates. And that is why, if we're not near a credit event, which it doesn't seem to be that we're near a credit event right now, that rates will not be falling. But that is not the case. I went back and looked at all this. So LTCM bailout, that happened at the bottom of the 10-year at that time. We had a phase 1 and then a phase 2 going into the dot-com recession. Then in the Great Financial Crisis, we had phase 1. You can see the 10-year is going higher. And then phase 2 happens where it hits that tipping point. It starts coming down way before recession, like about 6 months to a year before actual recession. Bear Stearns happens down here at a local bottom. Lehman happens up here at the local top, and then it keeps going down. So these credit events do not happen at the top. Here's another one. Back in 2018 into 2019, we had phase 1 where the 10-year was going higher. Phase 2, the 10-year starting to come down. We didn't have the repo rumble until this bottom right here in September of 2019. Of course, then we had another credit event we could call COVID a credit event because treasury markets did freeze up there as well. But you can see these credit events happened at the bottoms of cycles normally, or at least halfway through the cycles. Now I think we are in phase 1, and phase 1 is about to end. Phase 2 is when it rolls over. When we hit this tipping point where the collateral reuse and these collateral chains start shrinking, the elasticity of rehypothecated treasuries gets more inelastic. People can't source them, and we have a flood out of the shadow banking system into demand for direct treasuries, and yields start falling. So that is, I hope, a good explanation of this, but that is where I'm going to leave it here for today, guys. Thank you for joining me. Ansel Lindner, Bitcoin and Markets. Check out bitcoinandmarkets.com. Also check out bmpro.substack.com. My latest article came out today over there. I want to thank everybody watching on YouTube, Rumble, like, subscribe, comment down below. Thanks to my guys over on Telegram for hanging out. This was a cosmic one, but I hope we all learned something. And that's going to do it. Thanks, guys. See you next time.